Hello and welcome to Market Matters presented by MIAX. I'm Joe Teague of Equity Armor Investments, and with me is Brian Stutland. Brian, how are you doing?
Joe, great, great. Happy Monday. Markets are off to a good start this week. Rebalancing, moving higher, I guess, removing what the bad of April was, and a decent start to May right now.
Yeah, really got a nice turnaround in the markets, and I think it coincided with our big story of the day. We're going to get into it as a bit as oil prices were in focus around the Iran-Israel tensions. Also, interest rates were peaking at that time. Since then, we've been in a risk-on mode, and we want to look at what are the risks of that happening, and is this like before? Well, I think one of the key differences to before is the U.S. is such a bigger player in the world when it comes to production right now in oil. But there's a lot to unpack in that, and I really can't wait to look at all of it later in the show.
Yeah, we're going to get into on this show. We're going to get into the correlation between oil prices, interest rates, how that affects the market, because it's really interesting how a recession could be coming when you're watching oil move higher. So we'll get into that.
Yeah, past couple of weeks we've had huge economic data points. Not a lot this week. Got past the jobs report. Not a lot on the horizon. We had really big earnings reports the previous 2 weeks. Again, some interesting ones this week, but not the same market caps which we've seen recently. So it's a lighter week when it comes to economic news, a lighter week when it comes to earnings, Brian.
Yeah, well, I think it'll be interesting to see how Disney plays out. Obviously, a lot of shareholders there want to know how that transition is taking place and how they're moving forward. And then Palantir is really that defense stock / AI play. So it'll be great to hear what they have to say after the close today.
Yeah, we've talked about Palantir before. We're really excited about their potential, but again, they're just getting started. I'm really curious. It's up huge today ahead of the event, so that'll be an interesting event. But as I said, a lot of reports, we'll pass them already. Not surprising to see then volatility is a lot lower than where we were coming into last week, Brian.
Yeah, I mean, we talked about how volatility mean reverts, and we saw the volatility futures curve really shift up higher throughout the month of April. And now it's come back and sort of renormalized. The shape of the curve looks normal. Volatility is suppressed back down, actually even below to where it was a month or 2 months ago, which to me actually seems maybe it's gotten a little bit oversold. The VIX has come off its highs and really come down. The market's still moving a little bit here. So kind of an interesting play that maybe we get a little blip in the market, a little pullback just to, carpet shake people out to see if this market can move higher.
Yeah, we'll see if that remains to be seen. But yeah, I do like the shape is getting back into its normal fashion. It's actually kind of a steeper slope than normal. Does that tell you anything when you get like a steeper, VIX to the front month to the second month? Does that mean anything different to you?
Well, I think what it means is traders are sort of pushing out the volatility event, that it's not going to happen even on the upcoming CPI number here in May, and looking more towards June, July, August, sort of pushing out that volatility event. So we're probably smooth sailing for right now, but traders obviously looking ahead saying, look, we could get a volatility event that occurs that spikes volatility, a little market sell off, like I said, a little carpet shakeout. I would expect maybe something more like along the lines of as we get into the next Fed Reserve meeting, which isn't until June now.
And speaking of shakeouts, so this is something we track weekly. Around here, we were saying, hey, this looks like FOMO. People are buying too many calls. There's some downside risk. And right around here, we were saying, hey, it looks kind of oversold to the downside. Looks people are too high on the puts. We're kind of in the middle of that range now, Brian. Maybe we could go either way. There could be some more room to the downside in volatility, or we could be turning around soon.
Yeah, I think it's a 50-50 mix, really. But I mean, like, look, when the skew really shifted, the puts were getting bid up, like you said, they peaked. And then all of a sudden we saw call buyers come into the market, but volatility remained elevated. And to me, that's somewhat of a bullish sign that the market could rally. I think there's some technical levels we kind of got to get through. 18,200 on the NASDAQ, I think, is an area that will provide some level of resistance. The S&P really kind of around this like 5,200 level or so. So I think we need to move through those resistance levels where markets started breaking down before to sort of push and go higher. And then you'll probably see, call buyers maybe come packing in again, taking that skew, flatter down below that 2.0 level.
I guys got to be honest. So we got a risk on morning right now to start the week on a Monday. I kind of like where the skew is right in here. If we had a risk on morning and the calls were, way more expensive than normal and we were all the way down there, I would be a little more cautious, saying, hey, I don't want to chase here. But given that we're in the middle of this range, I think the bulls should have some sort of level of comfort here.
Yeah, I agree. That's a really, really good analysis there. So, we'll be watching this, and like I said, some technical levels that we got to get through here, and obviously, interest rates. That's a factor, right, Joe? I mean, the Fed has kind of moved the market a little bit on where people's expectations are. Wouldn't you say?
Yeah, this is where the risk on mode happened last week. The most probable event at the end of the year would have been one cut. We had this close to 40% here. That's the one cut spot right here. And the second most likely event was zero cuts. So this was one, this was two, and right now we're at the number one most likely event is two cuts. So we definitely shifted back to the left here, shifted back towards more cuts. The market's expecting more cuts. Maybe it's because of the softer economic data. We have not really seen the softer inflation yet, Brian.
Yeah, the bad news of unemployment ticking up was good news for the market. Less payroll jobs created than expected. We're now up to 3.9% on the unemployment rate, and that really shifted things back to wanting rate cuts. We've seen the 10-year now come off that 5% level, headed lower. And we've highlighted this before. When rates have increased, but then they kind of stop and they come back down a little bit, you usually kind of get a little bit of a rally in the market.
What do you think about Powell's I don't see the stag, I don't see the inflation comments? Is this going to be his George Bush mission accomplished moment?
It might be. Look, I mean, stagflation is like recession and inflation. So we're not there yet. I mean, that stagflation word is a little bit more over dramatic by definition. But are we in this environment where inflation is a little bit of concern while unemployment rates are going higher? To me, that's stagflation-y, not stagflation itself. And a little bit of concern that will start to crimp the actual GDP and growth numbers in the coming quarters.
Yeah. So, anyways, we're at the point where the Fed has raised rates really quickly, and now we're flat, and that kind of brings us to our big story here. And of course, we're talking about oil, we're talking about the geopolitical risks out there. But I went back and I looked at recent recessions here, Brian, and I went back and looked at kind of like the situation or the triggers or the setup to what happens when there's a recession. And we're kind of right there in place with it. Now, a lot of these times took a long time to materialize. But if you go back in time looking at these recent recessions, I went also through in 1929 and therefore for good measure, there's a trigger event. There's some sort of catalyst. There's some sort of event that after these scenarios are put in place, it starts the recession. Now, 2020, very unusual. There's a pandemic. I don't expect that to happen again. Certainly hope not. But if you go back in time, maybe in 1929 and in 2000, you had these events in place, and then there was an overvaluation in the stock market, followed by a huge crash and correction, and that actually triggered the recession in those two instances. But the other times, and actually the most common start to a recession happens with an oil shock. When I'm saying oil shock, I mean a 40% increase in oil prices over a quarter. So a big increase in oil prices leads to a recession. So we have that set up in place. We have the geopolitical risks there in place with the tensions in Israel and Hamas and Iran and everything. So the cards are dealt, and it could happen. Is the narrative of the story?
Yeah, I mean, the thing is here is like when you look at other countries throughout the world that sort of have a footprint on the oil supply in this world, is when there's sort of these hints of inflation, they try and step on the gas and make it worse, maybe try and create some turmoil, some tension in the world, get oil prices higher because they know that's a very negative impact on the U.S. economy. And as we've seen it, that's the most common way a recession occurs. Now, when we look at some of these big stock crashes, so to speak, these are coming off of massive valuations in the stock market. I don't think we're in that realm just yet. So to me, stocks are okay. It's really the commodity world that concerns me the most. And we have seen oil prices back off now, right? They got up into the $80 plus range, just weeks ago. Now they've kind of backed off. So it would be great to see things sort of simmer down in the Middle East and keep things under control where oil kind of hangs in there. But certainly you talk about the 40% up move. Oil has had a nice bottoming process going back to last year. And so that still is a little bit of a worry for me.
So yeah, you talk about how valuations are nowhere near where they would be for a stock market crash. But it might get stretched out to that point. In 1929, the yield curve was inverted for a very long time. 2006, the yield curve was inverted in 2008. So these things can take a long time, and with all the money that the government is spending, this can be stretched out for a while here. This current yield curve inversion. But yeah, let's take a look at where we are right now with the S&P 500. Realistically, this looks kind of good to me, Brian. This looks like the market is breaking out. We're testing a new support at the previous resistance line, testing a new trend zone. This really looks promising, especially with the risk on trade we have going on today.
Yeah, I mean, it really did hold the breakout level we saw back at the start of this year. And obviously we had some profit taking in April, and now it's kind of held in there. We've seen, just to button up on the oil talk, we've seen oil come off its highs. So I think that's been very good. We've seen interest rates on the 10-year come off those highs of 5%, now lower there. So things are on the up and up from a technical and fundamental basis. One thing, though, I think is still, obviously, we talk about the turmoil in the Middle East and where that's going to go, and that's the unknown, right? And so I still would kind of be hedged as long as this market is sort of, I mean, we haven't reached that new trend channel that's going up higher. We just kind of broken out, retested this level. There's still risk of a breakdown. I would look for short-term put spreads, which, Joe, as you know, like in our strategies, that's what we like to do. We're both portfolio managers on a couple of mutual funds, and for clients, that's a trade we kind of are looking to stay short term, maybe buy a put spread, get some level of protection, but not cap our upside participation rate, because look, if this is a breakout, there's more room to run to the upside.
Yes, so that's crucial, and it's also crucial to keep an eye on oil. Now, this happened to be right when oil was peaking recently. I'm also concerned if we were to break down below here, that'd be a red flag for me. We're back in this trend line, out of this range. I'd be worried about the downside if this line does not continue as support. But I mentioned, this is right. This is right when oil was turning around for us. Really, really amazing, and it happened to coincide, Brian, actually, also with the peak, the recent peak in the 10-year yields. So it's really amazing. And you look at this chart, you have, the 10-year yields, which is hyper focused in on inflation. It recently, went higher again because inflation was in focus. Looked like inflation's coming back again. And then you look at the oil price against the 10-year yield, and you kind of take a step back and you realize, well, maybe inflation is really just about oil. The price of oil is really the most important thing. Is that right?
Yeah, I mean, it is uncanny. I had never realized we have been researching and looking at this now for a couple of weeks, and I never realized how well correlated oil is with the 10-year. And to your point, maybe inflation really is just oil. And that sort of, we have a newsletter called The Ripple Effect that people can subscribe to. You can go on at equityarmorinvestments.com and check that out. But on the newsletter, we call it the ripple effect. The reason being is that when a bowling ball, so to speak, drops in one end of the pool, it creates a wave throughout the system. And it seems like oil is that bowling ball drop when it goes higher, creating this ripple effect on pricing, both in interest rates, inflationary environment, and, the stock market, as we showed, recessionary periods being related to those oil shocks. So it's interesting how well this correlates. And if I look at this graph real quick, I would say that maybe the 10-year needs to come down a little bit lower. It's kind of gotten up ahead of where crude has been, basically in the last couple of weeks.
Yeah, I mean, there's still some geopolitical concerns out there. Maybe the 10 years ahead of that somehow when it comes to oil. But yeah, there's a lot going on underneath the price of oil too. A lot of it's, the how hot the economy is. There's a lot certainly a lot of factors, but yes, oil is just in everything. It is, the cost of transportation of everything. It is so crucial to the prices of things. So yeah, it makes a lot of sense that inflation essentially is what oil is. And unfortunately for like the economists, it's like a really random variable and it's out of people's control. And these shocks just can come up out of nowhere and just absolutely put a damper and just throw a wet towel on the economy.
Yeah, and I think if we're really looking at it, if you look at crude, I think the $75 a barrel level really is one to watch. That's kind of where it kind of broke out to the upside in April, and so that would be one to see. I mean, the reason why we're bringing this up now is we're getting into the driving season. Memorial Day is around the corner. I think a lot of people are feeling good about how good the weather is recently, getting out of those April showers here in the Midwest and into the May flowers. And as you look at that, typically oil will trend higher into this May, June, July driving season. So it'll be interesting to see if oil sort of holds this level, can get above $75 and stay bid. That would be a concern for me.
Yeah, I mean, and also just the geopolitical concerns. Going back to our point before, it's 1990 oil shock happened with Kuwait when Saddam Hussein invaded Kuwait. 79 and 74, there was a decade's worth of tension between Israel and their neighbors. So these geopolitical tensions in the Middle East has led to these shocks before. So it does mean that we should pay attention to it. Thankfully, we have not seen it yet. Thankfully, it looks like oil is going lower. Also, it's great that the U.S. produces a lot more oil than it did back then. So it has a lot of defenses built in there. But if there is an oil shock, I am definitely concerned about this spot right here.
Yeah. And so, all right. So, Joe, if you've got nothing else here, I would love to actually because the market is turning, right? And our trade of the week, we're talking about NVIDIA, right? And so, certainly, if the market's going to turn and move higher, as we saw that breakout on that chart above that trend channel, it's been the semiconductors that have led the charge, and specifically NVIDIA has been one that has been really a market leader here. And when you look at some of these, I think there's some nice technicals here, Joe. When you look at NVIDIA breaking down, it kind of looked like a sort of head and shoulder top, and it broke down lower, and now it's trading back above that neckline, which typically stocks will move then back to all-time highs as they sort of fail to make a topping pattern. And then you get the semiconductor index, or SMH, which you can trade through an ETF, also had this sort of flagging consolidation, broke down, and now is moving back up towards that breakdown trend line. So I think this is an interesting look, and maybe those are leaders that take this market higher.
Yeah, absolutely. When you get those yields coming down, you get that risk on trade. You look for leadership. Semiconductors have been that leadership. The leadership within the leadership has been NVIDIA. Just a phenomenal story. It has had this tremendous run. Some people might think, it's too late. We've already missed the boat. But just the setup right here on this chart looks appetizing to me. Looks like it wants to, if not test those all-time highs, make new all-time highs. And they have earnings coming up, Brian.
Yeah, I mean, normally we'd give a trade on like an earnings week, and you see there NVIDIA earnings May 22nd. So I'm looking at options going out to May 24th expiry, just to take place just after that earnings event. Normally we'd give that trade the week of, but I think it's kind of timely here because of the technical reversal that we've seen in the semiconductors recently. I think the time is right to play a bullish trade. And so what we have here is both a call spread that I want to buy, and coupling that with a put spread I want to sell. So I use the sale of the put spread, those proceeds I take in, and I use that to purchase the call spread. So now I've created a trade spread where I'm only paying $6.50, which is less than 10 basis points on the value of the stock itself, right? Now, obviously, I have to be prepared to be put to the stock at 850 because I'm selling the 850, 750 put spread. I'd have risk from 850 down to 750 on the put spread, where I'd have to own the stock and I'd participate in the losses on the downside. But the good news is on the upside, the call spread, the 950, 1050 call spread, I get to participate to the upside. You look at earnings, this stock has had now 3 times, a 16% move, a 24% move, and I think somewhere close to 20% in the last, let's call it year and a half of earnings after the earnings event. So certainly that could take us up through 1050, and we have a lot of open interest in the call strikes of the 950 strike and the 1000 strike, which maybe acts as a repellent and allows the stock to blow through those strike prices and move higher.
Yeah, and I like this trade given that where we are with the momentum ahead of the earnings gives you a lot of time for this to work. And really, this might be something where you're sitting at 1,000 before the earnings event and decide to just take your winner right there.
Yeah, I was at an event at Churchill Downs this last week, meeting with some investment advisors that we put on, and we kind of talked a little bit about valuations, what a PE means. I mean, do you put any stock in what NVIDIA PE really means, or is it all just the story of revenue growth?
The PE is less important than the forward PE, or in other words, their projections. So that's going to be the key to me. Their projections are very big. People are talking about, how crazy it seems, but they lived up to them for the past year and a half, which has been astonishing for them to be able to meet and beat those expectations, which has been amazing. And it's really been an interesting quarter so far for the semiconductors, Brian. We've seen, AMD, the Taiwan Semi, they've actually kind of struggled. SMCI, they've kind of struggled. They're kind of saying, hey, maybe there's a little weaker demand. But at the same time, you're getting companies like Meta and Apple saying, hey, we're spending billions. We're spending a ton of money on this AI infrastructure. So is that going to be NVIDIA's gain? We'll wait and see how the earnings play out. I kind of like this trade right now for the momentum up until that earnings event. I think those 950 calls are going to remain some volatility. They're not going to decay ahead of this event. So I think that looks good from my point of view. I'm a little nervous on the actual event. We've seen so many big prints from NVIDIA on these earnings lately. Can they do it again? I think that's a tall order, but I can't wait to see it.
All right. Well, so, I mean, I assume we'll probably give an update maybe the week of earnings and where this trade is playing out at, and see if there's any adjustments to this. So please stay tuned. But Joe, this has been a great show. We tune in every week, Monday, 1 p.m. Eastern, Market Matters, sponsored by the MIAX. I'm Brian Stutland of Equity Armor Investments, and Joe. And we'll be back at you next week. So please tune in. We got some other great stuff going on. Subscribe to our YouTube channel, like the video, follow us on Twitter, wherever you want to be. Keep track with us because we continue to update some of these ideas.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and/or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and/or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc., all rights reserved, member FINRA SIPC.